Now that we have our flexible budget completed, right in the middle here, we can go ahead and calculate the different variances. So anytime that you're comparing your flexible budget numbers to your planning budget numbers, any differences are going to be called activity variances. The reason for that is because both budgets here, the planning and the flexible, both of them use those same cost and revenue formulas. The thing differentiating the two is the level of activity used. So the only reason that there would be a difference between the numbers in the flexible versus the planning budget is because of a difference in activity. So these variances are called activity variances. However, when we compare our actual results to the flexible budget, remember the flexible budget says what our revenues and expenses should have been given the actual level of activity. When we compare the actual to the flexible, the variances that we find between these two will be called either a revenue variance or spending variances, because they do not share formulas in this case, right? Because your actual numbers are your actual numbers. There's no formula necessarily that we use to get to these. That is what our revenue was, and that is what our expenses actually came out to be. But the flexible budget, we actually use cost and revenue formulas to find its numbers. But what do the both of them share? Well, the actual results in the flexible budget, they both use the same level of activity, which is our actual level of activity. So it's not a variance in activity level that explains the differences between these two. It'll be a difference in what came in per lawn mowed and a difference between what was actually spent on these various expenses. So the variance in terms of our expenses, the variances we will see between actual and flexible, we will call those spending variances. So let's compute our activity variances first, and we will start with our revenue amount here. So we'll compare our flexible budget to our planning budget. So when you find the activity variances, you want to start with the flexible number and then subtract the planning number from that one. And when you find the variance itself, you want to find the absolute value of the difference. And here in Excel, if you were to subtract one cell from another, sometimes it will spit out a negative number. But just keep in mind, in Connect, you want to put in the absolute value of that difference. All right, so for the first one, so we'll just do it in the calculator here. The revenue for the flexible budget, what revenue should have been for the actual level of activity minus what we planned for revenue to be, that's a difference of $37.50. Now, we need to label this as either favorable or unfavorable. And in this case, we're going to label this activity variance as favorable, because whenever you're comparing a flexible revenue item to a planning revenue item, if the flexible revenue is more than the planning, it's going to be favorable. Because what's the only thing explaining the difference between this revenue under the flexible budget and the revenue under the planning budget? Well, they both use the same revenue formula, so the only difference is the difference in activity level. And when it comes to revenue, the higher the activity, the higher the revenue. So in this case, because we have 50 more lawns being mowed in actuality, that leads to a favorable activity variance here when you're comparing the revenue under the flexible budget to the revenue under the planning budget. So we're going to do the same thing now for all these expenses. So we can see here that the flexible budget, we ended up calculating out $21,500 in wages and salaries versus the $20,000 we had planned for. So we should have spent $21,500 on wages and salaries, but we planned for $20,000. So here we can see that's a variance of $1,500. Now, is that favorable or unfavorable? Well, when it comes to expenses, costs, when the amount that you should have spent is more than what you planned to spend, we're going to label that as an unfavorable activity variance. And why would we label that as unfavorable? Well, simply because of this. When it comes to mixed and variable costs, based on how they behave, as activity goes up, mixed and variable costs also go up. So here, between planning and flexible, our activity rate is 50 lawns more under flexible. So the higher the activity, the higher the cost when it comes to mixed and variable cost. So here, because the amount that we should have spent is higher than what we planned for, simply because of a higher actual activity, we will label that variance as unfavorable. Now let's take a look at gasoline and supplies. We should have spent $4,950. We only plan to spend $4,500. So we can see here that's a variance of $450. But is that favorable or unfavorable? Well, again, in this case, we should have spent more than what we planned for. So that's unfavorable simply because of the higher activity level in actuality. Because gasoline and supplies, what kind of cost is that one? It's a variable cost, right? We can look at its cost formula there. And variable costs, per unit, they stay the same, but what do we know about variable costs in total? Well, they're proportionate to the changes in activity. So as activity goes up, variable costs also go up. Well, this is a strictly variable cost. At 500 lawns, we can see that the planned cost is $4,500, but at 550 lawns, that cost is going to have to go up to $4,950. And we're simply labeling this variance of 450 as unfavorable simply because of how a variable cost behaves. When activity goes up, that cost goes up as well. So that's an unavoidable relationship and cause and effect there. With certain costs based on the behavior, as activity goes up, costs go up. But same thing with revenue, right? It's a give and take there. As activity goes up, we expect revenue to also go up, but the same thing for expenses as well. Now let's do the same here for equipment maintenance. So we should have spent $1,650 based on that cost formula and our actual activity, but we only planned for $1,500 because we only thought we were going to have to mow 500 lawns. So we can see here there's a $150 variance, activity variance. Is that favorable or unfavorable? Unfavorable, once again, simply because of the higher level of activity, and it's a strictly variable cost, and the higher the activity, the higher the variable cost. And we can see here now for office and shop utilities down to insurance, there are no variances here, right? Because both of these budgets use the same cost formulas, and these costs are fixed, and fixed costs stay the same in total as activity changes, right? Within the relevant range at least. So there are no variances there for those fixed costs. But what about our total expenses? We can do the total amount as well. So we should have spent $34,600 on total expenses, but we only plan to spend $32,500. So there's a variance there of $2,100. Oop, in the wrong spot there. $2,100. Is that favorable or unfavorable? Well, it's unfavorable because the amount that we should have spent is more than what we planned to spend. When it comes to expenses, when that is higher, it's unfavorable. Now let's compare our net operating income. Our net operating income should have been $6,650. Compare that to the planned net operating income of $5,000. We can see that there's a variance there of $1,650. But if we're talking about net operating income, if your net operating income should have been $6,650, but you planned for $5,000, that's actually a favorable variance, right? Because here, that variance in activity of 50 more lawns in actuality than what we planned for leads to a favorable net operating income activity variance there. So I'm going to pause the video here and we'll continue by completing our revenue and spending variances.